recent rise in Treasury yields has made bonds look very attractive to investors. That's just fascinating. Let's bring in Priya Misra. She's global head of rate strategy. So it's rate strategy. So we may not talk at all about stocks at TD Securities. But Priya, I'm reading all of your comments, and you're pretty hawkish. That's why it's so interesting that you're buying the 10-year, because you don't think it applies to the 10-year. You think that the 2-year and that the Fed may go even further than people are expecting, maybe all the way to 5.5%. That would be on Fed funds at this point?
Right. Yeah. So, I think the Fed is fighting the inflation monster right now. And our view is that inflation has, probably peaked, but it's going to be really hard to get to that 2% target. And the Fed is committed to that 2% target. So I think they're going to have to keep hiking these 25 basis point increments. I mean, 5.5. I wouldn't put it past them to go to 5.75, 6%. I think they really need to see clear signs that inflation's getting to their 2% target. The problem is that I think that all this talk around the no landing scenario or the soft landing, I think you're really fighting the Fed. The Fed is telling us that they're going to slow things down. And our view is there's no way to get inflation to 2% without the Fed slowing the labor market. So the reason I like the long end is the long end is not pricing it. So 10s, 30s, I would say even 5-year treasuries is not pricing in a hard landing. Our view is the Fed is telling you they're going to have to slow things down. If you're thinking about treasuries, longer term treasuries, that's pricing in a chance of a recession next year. I think it's much higher chance of recession will actually happen. So I think owning the 10-year is positioning for the economy slowing down. It's a safe haven move away from risk assets. I think a lot of people are going into cash. I think cash is fine for now. It gives you liquidity. But really, will cash be there when the economy heads into a recession and the Fed starts to cut rates? We don't expect any rate cuts this year, but next year, I think if the unemployment rate is getting close to 5%, the Fed's going to start to cut rates. So then that cash, which is great right now, doesn't look that great, which is why I would say owning some treasuries, hard to say whether 4% is going to be the peak or 4.25. But I think you're supposed to have some duration risk in your portfolio, especially if you have risk assets. It's a great hedge if we head into a recession.